All right, let's take a look at some weekly charts. We've got some initial indications that the dollar has put in possibly an intermediate cycle low. We've got a swing low right here. Um, this week's moved above last week's intra-week high. Got a little bit of follow through to the upside. Um, it's very late in the intermediate cycle. I think we're about 25 weeks or so into this, so it's due. I'm really not anticipating another complete daily cycle, that might come down and bottom in October or November. I think it's probably too late for that. We've got a cross on the weekly stochastics. So uh, I'm fairly convinced we put in an intermediate cycle low. This should be a counter trend rally, a bear market rally, and it should left translate. So I'm really only anticipating, um, maybe 5 to 8 weeks before the dollar tops and rolls over. This would be week one of the advancing phase of a new intermediate cycle. It's not unusual during the recognition phase of a new bear market to come back up and kind of kiss the 200-day moving average goodbye one last time. This is the 40-week moving average, which is basically the same thing as the 200-day moving average. So that's kind of what I'm expecting here over the next 4 to 7 weeks would be a rally to come back up and tag this. Maybe we rally into the elections. The elections are such a huge event um, right now that they have the potential to be a trigger event to change intermediate trends. So it looks to me like the intermediate trend in the dollar has turned, and we're going to get a counter trend rally, and that's as you'll see, I think that is likely to produce intermediate trend changes in stocks, oil, and gold, and then potentially all of those trends will reverse, and I think those will be counter trends as well. Those will reverse either mid-October or maybe right after the election. So right now, it looks to me like the dollar is starting a counter trend bear market rally, and the other asset classes are starting counter trend corrective moves. So let's move over to the stock market. All right. We've got a weekly swing high. We've got an indecision candle here on the weekly charts. We've got we had a little follow through this week, broke this low, so that qualifies this as a weekly swing high. It's occurring very late in a very strong intermediate rally. The weekly stochastics are starting to turn down. Um, Again, if we're clearly we're in a bull market. Um, Even if we're still in a bubble phase, and I don't see anything yet to change my mind, an intermediate degree correction is perfectly legitimate, even in a bubble phase. So we could definitely come back down and kind of kiss this 200 day moving average. Again, this is the 40-week moving average, roughly same thing. We could come back down, kiss that goodbye, and then start the bubble, uh, resume the bubble phase in the stock market. I'm not, quite as confident that's going to happen because we've got some extreme government intervention. We've got a lot of central bank QE, so I wouldn't bet the farm on this. I'm certainly not going to short the stock market under the assumption this will happen because you throw enough QE in a market and then you can probably short circuit these corrective moves. So, but as of this week anyway, this has the fingerprints of an intermediate top trying to form as the dollar forms an intermediate bottom. And the weekly stochastics, as you can see here, have crossed over, turned down. Um, I think it's not out of the question that we could get oversold on the weekly stochastics during an intermediate correction, and then that would set the stage for the next leg up in the bull market, and maybe the next phase, maybe even ignites the final bubble phase in stocks. All right, now I'm looking at a chart of oil. We've got weekly swings in oil as well. Again, this is basically the same thing as the 200-day moving average. You can see this kind of looks like a bear market rally. It came up, tried to get above this declining 200-day moving average, was not able to hold it, and is now turning back down. The weekly stochastics are turning down. That would, that for me, that's a warning sign that oil has probably also started an intermediate decline. If oil is in an intermediate decline, stocks are probably going to follow it down unless the government can intervene strong enough to short circuit the selling in the stock market. Again, I'm certainly not going to trade it that way. I'm willing to sit on the sidelines for now until I'm proven wrong. And if it's clear that we're going to get enough QE and enough government intervention to stop the correction in the stock market, then I'll have to jump back in. But right now, I'm going to assume that stocks are dropping down into an intermediate, or have begun the declining phase of the intermediate cycle. We're beginning an ICL correction. Same thing here for oil. And now let's move on to gold. All right, so gold, I see a lot of people that are still extremely bullish on gold, or they've just become conditioned to expect that gold can't go down. We've got a weekly swing here, and we have produced really nothing here to convince me that we aren't going to have an intermediate degree correction. We're getting very late in the daily cycle, at risk of starting that plunge down into the next daily cycle low. In order to change my mind and convince me that this intermediate cycle is just going to continue to stretch and stretch and stretch, I'd have to see a move back above this peak back here at the first part of August, and right now, we aren't really even close to that happening. So far, this is just doing kind of what I anticipated it would do. It's churning sideways after that initial crash event. And the later we get in this daily cycle, the higher the odds become that this churn will break to the downside. If we're going to recover this, gold needs to get busy doing it immediately before we run out of time during this daily cycle. All right, so here's the daily chart. You can see this has just been a very weak fourth daily cycle, and it's always dangerous to assume that a fourth daily cycle is going to give you a strong trend higher. It's really too late in the intermediate cycle to bet that way. Most of the time, a fourth daily cycle will left translate and start to move down into an intermediate cycle low. And as it stands right now, we've got a top on day 4. So there's nothing here at this point to convince me that this isn't a fourth daily cycle that has topped on day 4 and is left translating. You can see we've tested this intermediate trend line a couple times. We've got a warning signal with a slight penetration below the intermediate trend line right here. We ended Friday with price kind of more or less setting right on that trend line. If we get any weakness at all next week, then we're in jeopardy of closing below that trend line. And when you get just multiple tests of this, it's between that 2011 high at 1923. What gold is doing is it's testing over and over and over that old high at 1923. Now, if we could test it once or twice and then take off, I would be confident that it's just a retest, and then we're starting the next sustained leg up. But that's not what's happening here. We're hitting it over and over and over, and usually that's not a good sign. You keep knocking on the door enough times, and eventually price goes through the door. So this is not really the pattern that I would like to see. That would convince me that gold is just retesting that 1923, and then it's going to take off to the upside. Like I said, if it had done that once or twice and then started a sustained move higher, then I would be convinced that it's just a kind of a kiss goodbye to the 1923 area, but we're just hitting it way too many times here to make me comfortable. And with the dollar showing signs of an intermediate top, this is just looking like a daily cycle that is left translating, topped on day 4, and is at risk. If we continue to get strength in the dollar, which we should, like I said, I don't think it would be unusual for the dollar to bounce from the extremely stretched position and then go kiss that 200-day moving average goodbye in a counter trend rally before starting the next leg down in the bear market. And I suspect that's going to be the driver to eventually break down out of these multiple tests. At some point here, we'll get a move back below 1923 that sticks and doesn't recover. And then at that point, I think we probably get a violent breakdown from this and come back down and test this consolidation zone. So right now, I'm assuming that we're going to get an intermediate cycle low, just like we do, basically without fail every time. That the only time that I can remember in recent modern history where an intermediate cycle low in gold didn't really complete all the parameters was right before the bubble top in 2011. We got a very shallow intermediate cycle low that didn't really look like an intermediate cycle low, and then we started that final move to the bull market high in the fall of 2011. And I don't think we're in that kind of environment right now. It's we're just now trying to break out above those 2011 highs. This doesn't look like the kind of panic buying, retail traders all swarming into the market at any price type behavior that we saw in 2011. This looks like a market that's trying to break out above 1923. It did here, and it got briefly above 2000, but then couldn't hold that. No sign of a sustained move, and then just too many tests of that 1923 support level here. So my assumption at this point is that we're going to get a normal intermediate cycle low, and so this sideways churn, unlike here, is probably going to break downwards instead of upwards. And again, getting very late in a daily cycle. We're running out of time. If this is going to break higher, it needs to get busy doing it immediately. And so any move back below this intermediate trend line next week, I think is going to be a big warning sign. But as I've said many times before, intermediate cycle lows are your opportunity. They come around, maybe 2, at most 3 times a year. They are the big opportunities. So that's what we want to see as contrarians. We want to see an intermediate cycle low in all of these markets because it's going to give us our buying opportunity.